So get this, a company reports a staggering loss of nearly $500 million, but somehow the lights are still on. How is that even possible? Well, this isn't just a simple story of a company failing. Oh no, it's a fascinating look at some accounting magic, a terrifying mountain of debt, and one heck of a gamble on the future of West Coast real estate.
And if you want to know just how intense this whole situation is, just look at this number. This is the stock price for Hudson Pacific Properties, or HPPs, we'll call them. At under $2 a share, well, the market is sending a very, very clear signal.
And there's really no sugarcoating it. You know those financial models that try to predict if a company's going bankrupt? Well, they are all flashing bright red for HPP. They're placing it squarely in what they call the distress zone, which means the stakes here are about as high as they get.
Okay, so let's peel back the layers here and really get into the story of a real estate giant that is fighting for its life.
First off, who are we even talking about? Well, Hudson Pacific Properties is what's known as a REIT, a real estate investment trust. Basically, they own and operate a ton of office buildings and movie studios, and they're almost all on the U.S. West Coast. And who are their biggest customers? You guessed it, the tech and media industries. Two sectors that have been absolutely rocked by, well, everything, from the shift to remote work to the big Hollywood strikes.
And that reliance on tech and media leads us right into the central mystery of HPP's finances. It's a puzzle that when you first look at it, just doesn't seem to make any sense at all. So, let's solve it together.
Okay, so on paper, things look like a complete catastrophe. Over the last year, the company reported an official net income loss of over $440 million. A number like that usually means a company is just hemorrhaging cash, right?
Which brings up the most obvious question in the world. How is this company even operating? I mean, if you're losing that kind of money, how are you paying your bills, your employees, your loans?
And boom, this is the aha moment. Just look at the difference here. While the official accounting number, the net income, shows that massive loss we just saw, the company's actual core operations, they generated positive cash, almost $62 million of it. So how can both of these things be true? What in the world explains this huge gap?
The secret is something called non-cash charges. These are basically accounting expenses that a company has to report. They reduce the official profit, but, and this is the absolute key, no actual cash ever leaves the bank account. The easiest example for real estate companies is depreciation. Think about it. A building gets older, so on paper its value goes down. That's an expense, even though the company didn't actually spend a dime.
And for HPP, these non-cash charges aren't just a small thing, they are enormous. We're talking hundreds of millions in depreciation and in asset write-downs, which is just a fancy way of saying their buildings are worth less on paper now. Once you add all these paper expenses back to that scary net loss, the math suddenly clicks. You can see how they actually get to a positive cash flow. So they aren't bleeding cash from their day-to-day business. Phew, at least, not yet.
So if the day-to-day operations aren't the problem, what is? Well, it turns out that solving that little cash flow puzzle just reveals a much, much bigger problem, and that is a massive looming mountain of debt.
And wow, this slide really puts it all into perspective, doesn't it? The company's total debt is nearly $4 billion, but its entire value on the stock market, its market cap, is only around $700 million. That means the debt is more than 5 times the value of the company's equity. That is a truly staggering amount of leverage.
All that debt makes up about 73% of the company's entire value. It's so risky that credit rating agencies have slapped a junk rating on it. But, and this is a big but, management isn't just sitting back and watching. They've been playing defense, securing over $1 billion in liquidity and kicking their major debt payments down the road. So now, nothing huge is due until the back half of 2026. They've bought themselves some time.
So what do you do with that time? You pull every single lever you can. And that brings us to the company's pretty aggressive survival playbook.
Just recently, management made 3 huge, you might even say drastic moves. First, they raised over $500 million in cash by just creating and selling a ton of new stock. Second, they renegotiated their debt to buy even more time. And third, they announced a 1-for-7 reverse stock split, which is a classic move companies use to pump up a falling share price so they don't get kicked off the stock exchange.
But here's the catch. That survival, it came at a really steep price, especially for anyone who already owned the stock. By issuing all those new shares to raise cash, they massively diluted the ownership pool. And you can see the result was just devastating for the value of each individual share. The on-paper net worth, or book value per share, got chopped by more than half. It means every owner's slice of the pie just got a whole lot smaller.
So, after all that, where does it leave us? Well, it leaves us with a very high-stakes bet on the future of an entire real estate market.
You know, one analyst really hit the nail on the head. He said buying HPP today isn't like buying a normal, stable real estate company. It's more like buying a lottery ticket, an option on a massive comeback for West Coast offices and movie studios. If that market recovers, all that debt that looks so dangerous right now could actually create huge returns. But if it doesn't, the stock could get completely wiped out.
And this slide just shows you how incredibly wide the range of outcomes really is. In a base case, where things just kind of stabilize, the stock might see a decent gain. In a bull case, if the market really roars back to life, doubling your money isn't out of the question. But then there's the bear case. If demand for office space stays weak, investors could lose another 50, maybe even 80% of their money from here. The risk is very, very real.
And if you look at the pros, the smart money, they are totally split on this. You've got short sellers, the people betting the price will fall, who are piling in. But then you look at the options market, and traders there are overwhelmingly betting on a price increase. The one thing everyone seems to agree on, the super high volatility, which basically means nobody has a clue what's going to happen next.
So, when you look past that really scary headline loss, what you find is a company that's actually making cash from its operations, but is getting absolutely crushed by a mountain of debt. Management has bought themselves some breathing room, but they did it at a huge cost to their existing owners. And all of that leaves us with the ultimate question. Is this stock a massive bargain, just waiting for a turnaround? Or is it a carefully set value trap?